Welcome to Podcast 83, a regular look at the news, stories, and trends related to Michigan's 83 counties from the Michigan Association of Counties.
Good afternoon, everyone. Welcome to Podcast 83, the podcast put on by the Michigan Association of Counties. Today, we have Deena and Steve, the Deena and Steve Show. And we have a really, I guess it could be complex. Well, one's going to be complex. One is fairly straightforward, but they both have to do with some tax policy issues that we've been working on for a long time. One kind of came about in the past year, right? The PPT exemption versus the veterans property tax exemption. Both worked on last year, had some momentum with both. And then, of course, with the way the lame duck session played itself out, we're not able to get closure the way we wanted to. So, Deena, why don't we first start with the veterans property tax exemption, a little more straightforward issue that we've been dealing with. Geez, when did that first piece of legislation get passed?
2013.
13. Okay, yeah, I thought it was quite a while. But we feel we have got a great solution to the problem.
Yeah.
There was some other supporters of it. So why don't you first take us back to where we were, what we've done, where we're looking to go.
All right. So yeah, just briefly mention that the two topics we're going to talk about right now are really kind of at the top of our priority list to get done this year, because every legislative session we talk about these same issues, and we need to get, a little bit more early momentum on them in order to get them done. But so the first one, veterans property tax exemption, that went into effect. State legislature decided that they were going to standardize disabled veterans property tax exemptions across the state. Originally, it was discretionary at the local level, and they could make their local decisions. And, I'm sure it was based on, income or, level of disability and those types of issues made at the local level. Well, the state in 2013 decided that they were going to standardize it and make it a complete exemption from property taxes for any veteran that was 100% disabled. Since then, that legislation has morphed into surviving widow or widower of a 100% disabled veteran. We get legislation all the time that wants to expand it out even further. Transfer of property to other family members, a remarried spouse. We've faced things like increasing the exemption for those that are 50% disabled and not 100% disabled. So we're constantly battling, not battling. I don't want to say battling. I want to say we're constantly faced with additional cuts to local government revenue from these exemptions.
And these exemptions, let's clarify too, are not right or wrong, but they are being voted on in the state legislature. So we went from a local controlled decision, to a state decision mandating locals give these exemptions for right.
Exactly. The legislature loves to make those grand gestures, whether it be business taxes or property taxes, and give away local revenue. Great idea. They don't have to pay the price. The locals do.
Easy vote.
Right, for sure. So, now, some things that we haven't really talked about, but if you think about it, it's an excellent benefit, especially for those, disabled veterans that are struggling financially. But there's no means test on this. It doesn't matter if they make $500,000 a year or $20,000 a year. 100% disabled is 100% disabled. But what we've seen since between I want to say 2015 to 2018 was the last time I had statistics on it. We've had an average of a 9% increase in 100% disabled veterans designation, those that are getting paid at 100% in the state of Michigan. Now, if you think about that, they're going to apply for it now. This is an excellent benefit to have. So we're having more and more veterans apply for that disability status, which means more and more properties go off of the local taxing rolls. That's a struggle. It costs a lot of money to the local level. So I guess, going from there, how much, everybody asks, how much does it cost? And each year it changes. So each year we try to get numbers, and each year it changes. The fiscal agencies estimate that it's somewhere around $86 million for fiscal year 23, going up to maybe $95 million, and 95 to $120 million in fiscal year 24. Those are dollars that the state, we did get reimbursed, would be coming out of the state's general fund. That's a huge hit on each individual local budget. I mean, counties get it, cities, townships, community colleges, school districts get property tax revenue. There's huge hits everywhere. And again, like you said at the beginning, Steve, not arguing the benefit at all. We're not arguing the benefit to the veterans. What we are saying is, if the state's going to have a great idea, let's figure out how to reimburse local units of government for those losses.
Yeah, it's you don't want to call it an unfunded mandate, but it's kind of a similar concept, right? The state has an idea, forces locals to do it, but doesn't pay for it. This is kind of the backdoor way of almost doing it, because great idea was the property tax exemption, and but they don't have to pay for it. So what are we've worked on this for a bunch of years now, and we been working very closely with the veterans service organizations, VSOs out there, other veteran groups, to kind of get to a point where they can be neutral or supportive on our concept, because we do still want those veterans to get that benefit, obviously, especially if they've already been getting it, but we do want to have a mechanism in place to reimburse us. So let's talk a little bit about where we've gotten to as far as some agreement. I don't want to speak for anyone, but we have had some discussions with groups that do kind of support conceptually where we're going.
So I'm going to give a huge shout out to Senator John Bumstead. He has really taken this issue under his wing and worked with us and worked with the veterans organizations over several years to come up with something that I think we all agree on. He introduced legislation last year. It passed out of the Senate. We were super close to getting it done. And it got kind of tangled up in some tax cut discussions earlier in the year, and then didn't really make it all the way through the process by the end of the legislative term. But what we've come up with is a reimbursement mechanism for local units of government that doesn't change anything for the disabled veteran. It's a different paperwork process for us, but it doesn't change what happens to the veteran. So we had looked at it before, and we thought, well, how about we just defer the property taxes, have an annual appropriation that is made to the department, and then the department reimburses local units of government. Well, every time we look at that proposal, it's not very attractive to us, because we don't necessarily trust the annual appropriations process. You've had several ideas on how to fund the reimbursement. Some of it was take away our personal property tax reimbursement money and give it back to us in the form of reimbursement for veterans property tax exemption. I think Senator Bolafave had, kind of funded with some pull tab revenue, capture some of that gambling revenue and set it aside to reimburse locals. But we think the most comprehensive approach was in Senate bills 783 and 784 from last year. Like I said, Senator John Bumstead's package. What that does is still requires the veteran to file that annual paperwork with the local taxing unit, the tax collecting unit. So whether it be the township or the city, prove that they're 100% disabled. And then at that point, their property taxes would be deferred. And they would state that they are going to claim an income tax exemption, a refundable income tax credit, a refundable income tax credit in the amount, at least in the amount of their property taxes. And then that amount would be payable to the local unit to reimburse us for that amount. And that was a seamless transition for the veteran. They're already going to apply for the exemption. They're already going to do their taxes. They don't have to worry about getting the money from the state and then turning around and paying their local unit. We came up with a mechanism that made it seamless for the veteran, which is why they agreed to it and supported this. Yes, it would be a little bit more paperwork on our end, and on the Department of Treasury's end. But then we're looking at, full reimbursement for our losses for this benefit. And like I said earlier, this is growing. So not only are the number of veterans who are claiming the 100% disabled status and payments growing each year by an average of 9%, we're seeing an increase in the amount of property going off the tax rolls and the value of that going up by about 14% per year. So that's why I said in like fiscal year 23, it's somewhere around 86 million. Then you're talking about, 96 million for a year later. That's $10 million. Did you hear me? I whispered it. $10 million. I wanted to scream it, so I whispered it. And that's a huge hit to all of these local budgets.
Yeah, so we're looking for reintroduction of that bill this session. We don't have, it's not yet, obviously very early in the session. So as we get that information, bill numbers, we'll be sure to pass it along through our weekly legislative update, maybe another podcast discussing it. But it seems like a great fix to a problem where we are still able to give that benefit to those disabled veterans, which is important, but still be able to keep local governments whole so they can still provide the services that are in many cases constitutionally mandated to their constituents. So moving along to another tax policy issue that a little more complex. Anytime you bring up PPT, personal property tax, it gets a little bit weedy. So we're going to try to not get too weedy, right, Deena?
He's glaring at me. If you're just listening and you can't see this, he's glaring at me as I get
wonky, weedy, whatever you call it.
Yeah.
But there was another issue that kind of got up in some tax cut momentum a few years ago. There was agreement for a reimbursement mechanism, however, never really got it done. So why don't we talk about that small business exemption loss that we experienced last year?
Okay. Just bear with me. I have to go back in time just a little bit so that you understand why it didn't get done in the first place. So it took decades of work and trying to figure this out until the former Lieutenant Governor Brian Calley and Nat Forstner, who most of you don't know, but actually came up with a method to eliminate the personal property tax on eligible manufacturing equipment. The whole idea was, let's get rid of this burdensome personal property tax for these businesses so that we keep them in the state of Michigan. And nobody likes personal property taxes. Nobody likes doing the inventory. Nobody likes assessing for it, figuring out the value, and clearly nobody likes paying the tax. So completely understood. And we were on board, sat through work groups, finally got, an agreement. It actually had to go to the vote of the people so that the state got reimbursed into their general fund for some of the money and had those businesses pay into that, what we call an essential services assessment. But how locals got reimbursed, we created the Local Community Stabilization Authority and a carve out in state statute of a flat dollar amount for each year that was an estimate on what our losses would be. The devil's always in the details though. So how does Ingham County get reimbursed? How does the city of Royal Oak get reimbursed for what their actual losses are? We had to come up with a formula to make it work. And, to make it as simple as possible, there are all kinds of caveats, of course, but to make it as simple as possible, whatever you were collecting in the year that this went into effect, and I want to say the base year was 2013, but don't quote me on it, was where you started. So that was your base amount. And then whatever you were collecting in 2016, which would be less because this equipment is taken off the books, that difference is what you got paid. Well, as you go through time, you get growth. Many counties and cities and townships across the state have seen growth in different forms of personal property tax. So let's say you have a new big box retailer go in, you have a new Meijer go in, or a Menards, and they have to pay personal property tax because they're commercial. They're not industrial or they're not manufacturing eligible personal property. Okay. So you have that growth. So now what you're collecting in personal property tax is bigger, but the formula was based on the difference between what you're collecting in the base year of 2013 and what you're collecting today. So you don't get that full reimbursement until you get to what we call the third tier. And that third tier sends out payments to local units of government to make up for that difference, to allow them to have that growth. And I say all of that because that third tier is extremely important, especially in this conversation. Now, fast forward to December of 2021. And in December of 2021, the legislature passed an economic development supplemental bill. It was part of their allocation of ARPA funds, but they also decided that they were going to increase the personal property tax exemption, okay, for small businesses. During the first round, anything from $0 to $80,000 in personal property was exempt. In December of 2021, they decided, okay, in 2024 or 2023, we are going to allow anything from $0 to $180,000 of property exempt. So, that takes a significant amount of personal property tax out of local budgets. So how do we get reimbursed for that? And we had a commitment from Senate leadership. We had a commitment from House leadership that they were going to actually get this done. They set aside $75 million, but still just sitting there to give us a reimbursement. We just had to figure out the formula. You know, that complicated formula I just said, we had to figure out a different one because it plays very differently. There's no base year and we had to figure it out. So we went through and we did figure it out. We figured out a good equitable way to allocate those funds. Those bills made it through the Senate prior to summer and they passed unanimously. They made it over to the House, and because session was so scattered and we had very few session days, we had a hard time getting it out of House Tax Policy Committee. So finally, the last day of session, it got discharged from tax policy, taken out onto the House floor, and at the last minute, they decided they were not going to vote for it, even though it passed unanimously out of the Senate, because that third tier that I talked about earlier. There are many representatives who don't understand why that exists, and they consider that to be bonus money. It's not bonus money. That is reimbursement for our losses and still allowing for us to collect taxes on any kind of growth in our community from other personal property tax. But because they were confused, and some of them have remained that way for years, they decided that they were not going to vote for it and not reimburse locals for that additional loss in personal property tax revenue.
So hopefully,
July plays over. That was terrible. I know, but
well, hopefully we didn't lose half the audience on that description. But to put it in a nutshell, there was money coming through the PPT original change, right?
Yep.
There was an increase in an exemption again, right?
Yep.
Caused a loss to locals.
Yeah.
Legislature set money aside to reimburse for that loss, what the estimated loss was.
Yeah.
Said, find a formula to distribute it. We've got the money. We did so, still never got it done. So this, we'll be doing the same thing again this session, right? We're going to get something introduced that basically says what we did last year. And hopefully we'll push that to get through fairly soon, because it should be all ready to go. Because even though we have, well, I'm not going to say that, because we do have a very new green legislature that explanation Deena just did will have to go through again numerous times to get everyone to understand this, because it is very confusing. So hopefully, once we have bills and sponsors and everything, we'll be sure to pass that along to everyone, so you folks can help with getting that knowledge passed to the legislators.
It's very long. It's very complicated. Sorry, Steve. So if any of our members out there want me to walk them through it again, I'd be happy to. It's much easier when I'm talking and I can use my hands and draw numbers on a board to explain it a little bit, but they're all going to face that same pushback. Don't you get bonus money? No, it is not bonus money. It is not bonus money. That category was there for a reason. And that's what we have to combat all the time.
Right. And there are some high-level talking points on our website under all our priorities. So those can be used as well if you're looking for some quick information. They don't certainly go into the depth that we're talking today, but they do give you some high-level talking points that you can use with your legislators. So with that, Deena, did you have anything else you wanted to touch on?
I don't think so. I mean, we have other priorities out there established for this year. And so maybe listen to our regular podcast for those. We'll give you updates on those on a regular basis. And then I think, Steve, are you planning on doing a deep dive into the other priorities as well?
Yeah, some of them we will be doing some individual podcasts on. Some of them we'll just update as we go throughout the year, and there is legislation introduced, and we'll keep people updated that way. But we definitely wanted to highlight these two today, and thank you, Deena, for your time and great explanation on that. And everyone, please stay tuned to our weekly podcast. We are trying to be more consistent in 2023 with our podcasts. Usually we're going to have some, one-on-ones with some individual subject matter experts. For example, there's some still, if you know, the foreclosure tax issue that we've dealt with in the past, there'll be a podcast on that with an attorney who's been working hard on that for over the past 5 years with our treasurers. We'll be doing a podcast on that. And then, of course, our normal weekly legislative updates as the legislature gets moving. We'll be passing the information along through that as well. So thank you for tuning in, and we'll see everyone soon.
Thank you for listening to today's episode of Podcast 83.